Hello, everyone, and welcome back to the Chamber Lunch. My name is Alda Yu, as the speaker stated. I'm the Human Resources Director at Kemper Development Company and a sponsor of today's program. We are so pleased to welcome you to today's event. Now, for those of you who may not know, the Bellevue Chamber is the most powerful advocate for East Side businesses. The Chamber has hundreds of members representing tens of thousands of employees, and we bring people together to address complex community issues, to network, and to help grow their business. Now, our Chamber Lunch series features celebrated speakers from around our region and dives into topics relative to today's business climate, and this is our third lunch of the 2025-26 event season and features local tax and finance experts. Now, before we get started with today's program, I would like to thank our sponsors for their continued support of this series. So a big thank you goes out to Vulcan Real Estate, the Bellevue Collection, Columbia Bank, and Clark Newber, as well as our media partners at Lotus. Shout out to Northwest News Radio, Talk Radio KVI, and HANK. Now, I'd also like to take a moment to recognize the dignitaries joining us today. Can you please stand up and give us a wave? Thank you. Thank you so much for serving the city, the region, and the community. Now, I'd also like to acknowledge the Bellevue Chamber board members for their involvement with the Chamber. Could the board members in attendance please stand and be recognized? Thank you. Now, we appreciate your efforts and are looking forward to another year supporting the Bellevue and the East Side communities. And last but not least, welcome to our newest Chamber members. Now, we are so glad you are here today, and we hope you are able to connect with some new faces before taking a seat today. Now, if time allows, we will be taking audience Q&As using the link up on the screen, bellevuechamber.org/ask. So feel free to submit your burning questions now or throughout the event. I'm sure we'll have a lot. Now, today we are joined by Cyndy Ranzau with RBC Wealth Management, Scott Edwards with Ballard Spahr, and Neil Strege, I hope I'm pronouncing your name right, thank you, with Washington Roundtable. Now, Cyndy will be kicking us off with a presentation on federal tax changes, followed by Scott giving us an update on state tax changes. And at the conclusion of the presentations, they will be joined on stage by Neil Strege for a conversation hosted by Joe Fain. Now, everyone, please join me in welcoming Cyndy on the stage.
Which is everyone's favorite conversation, I'm sure, especially after yesterday's check writing session to the government. So I wanted to give you a little bit of updates on some of the changes that happened last July. So the One Big Beautiful Bill Act was passed July 4th of last year, and that made some changes for individuals and for businesses. And I'm going to touch on both of those pretty briefly, but give you the broad overview. For individuals, the tax rates that were set to revert back to our 2017 tax brackets, basically that didn't happen. The sunset that we were all planning for never happened, so everything was made permanent. And by permanent, I mean until the next Congress changes it. So right now the tax rates are still capped at 37% rather than going back up to the 39.6%, which is great. The SALT deduction, which a lot of people are very aware of, maybe less so in Washington compared to some other states, but the state and local tax deduction had been capped at $10,000. That cap was increased to $40,000 if your income is below $500,000. There's a phase out. If you get up to $600,000, your cap is back at the $10,000. Nothing can be simple in federal income taxes, I can guarantee that. And that change is only good through 2029. And then in 2030, it goes back to the $10,000 cap. So lots of planning opportunities there, but it does make it a little bit confusing for most people. The other big change that happened is there's a new itemized deduction floor. So with your itemized deduction, starting in 2026, the first 0.5% of your adjusted gross income is not deductible, which for people who do the itemized deductions, like charitable deductions, the SALT, et cetera, that can have a pretty big impact. So as we're talking with clients, especially when it comes to charitable giving, we've been talking about potentially taking multiple years of charitable gifts and putting it into 1 year, so you're only subject to that 0.5% floor on those charitable gifts in 1 year versus multiple years. The other big thing that you probably have heard about is there's no tax on Social Security tips and overtime. Not quite true. There's a new deduction that's available for those who are 65 or older. It's a $6,000 deduction. You don't actually even have to be on Social Security to receive this deduction, but that new deduction only lasts through 2028. In 2029, it goes away. The same thing for the tips and overtime. There's a new deduction. It's not basically saying that there's no tax on tips or overtime. It just basically, there's a new deduction, and it only lasts for a few years, and then it goes away in 2029. The other big one that I wanted to mention in terms of for individuals is the estate tax. So there was a lot of conversation about potentially reducing the estate tax exemption at the end of last year. So a lot of planning was done. People took advantage of that really high exemption. Last year it was $13.99 million at the federal level. This year it's now $15 million, and it's still adjusted for inflation. And that has been made permanent. Again, permanent unless it's changed by another Congress in the future. My entire job has job security because Congress likes to make change. So on the business side, there's a couple of things here that are both for businesses and for individuals, so I'm going to touch on those first. The biggest one is the 199A deduction, so the qualified business income deduction. That was made permanent. It had been set to expire at the end of last year, but instead it was made permanent, which does help those of our business owners that have those pass-through entities to help bring that in line a little bit with the corporate tax rate for C Corps. The other big one is the opportunity zones were made a permanent part of our tax code, again, permanent. But the good news with that is if you have any clients who have, or if you have a large capital gain, starting in January of 2027, the opportunity zones are available once again for deferral of income taxes and some other tax benefits. The other one that I wanted to bring up with regard to that is the Section 1202 deduction. So the qualified small business stock deduction. This has been expanded for people who start businesses after July 5th of 2025. And the good news is it's increased how much you can potentially realize of capital gain without having to pay any tax on it. So it had been a $10 million cap, it's going up to $15 million. And for other business changes, the Section 179 deductions, that has been increased from 1.25 million to 2.5 million. The 100% bonus depreciation has been made permanent, which is a really good thing for our business owners. And then also the deductions for research and development have been made permanent. So there have been a lot of different changes that have occurred within this bill. There's a lot of other things that I'm not going to touch on, but I have provided a fact sheet that we have created that goes through a lot of these changes, plus some of the other ones that I haven't touched on today, and that will be made available to everyone who's here.
Good afternoon, and thank you for having me today. I'm going to speak a little bit about recent changes in Washington's state tax laws. I'm going to start with last year rather than this year. In 2025, we saw the legislature enact the largest tax increase in our state's history, and there were a number of significant new taxes as well as increases of existing taxes. And these are kind of the biggest ones based on the size. So there are B&O tax rates increased across the board. There are a number of surcharges that the legislature had enacted in recent years that were also increased. Probably the biggest one being well, it depends on who you talk to, the advanced computing surcharge or the workforce education surcharge, which is imposed only on large businesses and kind of the first time where the state is looking at a consolidated group rather than treating each legal entity as a separate taxpayer. The biggest one from my practice was the expansion of sales tax to a variety of services, and I'll be identifying some of those services lately. That created a tremendous amount of chaos and pandemonium. These changes went into effect or got passed at the end of the legislative session with almost no warning, no real discussion or debate, and a lot of the statutory language is very poorly written and doesn't really reflect how businesses operate. There was also new luxury taxes on cars, boats, and planes, as well as a gas tax hike, all rolled into one bill. And our beloved capital gains tax, as well as the state tax, saw increased rates and for the capital gains tax, lower thresholds of imposition. Then there were a variety of different provisions that the state likes to characterize as tax preferences. And the concept there is anything that the state doesn't take from you is a matter of legislative grace. And a tax preference is literally defined as anything that's less than the highest level of taxation. So they used to call this type of thing closing loopholes, but now they're calling it simply an elimination of preferences. To talk briefly about kind of the scope of the expansion of sales tax, it got broken into two categories. For some types of services, if the sale is to an affiliated company, it's not going to be subject to sales tax. And for others, it doesn't matter. So I've got those. One of the things that's been, I think, created some of the most confusion, if you look at the statute, it lists IT training services, technical support, and other similar services with a list that are all in that category, ending with data processing. The Department of Revenue characterizes this more broadly as a tax on IT services, period. And their guidance reflects that they intend to administer this much more broadly than the language of the statute suggests. Custom website development, investigation and security services. I have advertising and live presentations italicized here because those are also affected by something called digital automated services. Both of these used to be excluded from the scope of digital automated services and are no longer excluded, creating some uncertainty about the significance of whether either of these are taxed because they're now a retail sale or because they're no longer excluded from taxable digital automated services. Software customization is another big issue. And like I say, and I'm going to talk briefly about digital automated services. This is a concept that is unique to Washington State. And it's the definition, if you were to print it out, is about 2.5 pages long. But it starts basically any service transferred electronically that uses one or more software applications, and then excludes a large number of things. And that's what most of the language of the bill is. But in 2025, several significant exclusions were removed, making those things now subject to sales tax. One of the big ones is there was an exclusion for services that involve primarily human effort. Now the use of human effort doesn't prevent something from becoming a digital automated service. Advertising is probably the one that has gotten the most publicity because Washington is now the second state in the union to seek to impose sales tax on digital advertising. The Maryland tax that is being challenged as being unconstitutional or unlawful under federal law, the Internet Tax Freedom Act, because it's targeted just on digital advertising. The legislature is attempting to avoid that argument by nominally taxing all advertising, but then exempting everything but digital advertising. So while the department will talk about this as a tax on advertising services, it's a tax on digital advertising. One of the issues that becomes a real problem with the expansion of sales tax to all these services is trying to determine when is the sale a Washington sale subject to sales tax and when is it a non-Washington sale. All of these services were historically subject to tax under the B&O the service B&O classification, where they were apportioned formulaically. And the theory there is that the activity that generates the revenue is capable of occurring in multiple jurisdictions, and therefore you formulaically divide it among all of the jurisdictions where some activity contributes. Sales tax operates fundamentally differently, and the theory is regardless of whether there's contributing activity in different places, you can deem a sale as occurring at one specific location, and instead of apportioning the revenue among multiple places, that one location gets to tax 100% of it. So instead of going partially everywhere, it becomes all or nothing. And when it's all Washington or no Washington is going to be a big issue for figuring out retail sales. The statute basically sources services defined as a retail sale to the place where first use occurs. And there is zero guidance about how you determine what the first use of what any of these newly retail services are. That is going to be a very big and very messy and very complicated issue, and people who get it wrong are going to be unhappy both directions. As of yet, we still haven't seen any useful guidance from the department in that regard. So that will bring me to major changes for 2026. Biggest thing, and it took all the oxygen out of the room in the legislative session this past year, what is the income tax. Being billed as a millionaire's tax, as if putting the word millionaire creates some special structural element to it. Interestingly, the income tax doesn't go into effect until 2028, with the first tax payments due in 2029. As part of the negotiations to get the votes, there is going to be a rollback of some of the sales tax on services, but because the income tax revenue isn't going to be coming until 2029, the rollback of the sales tax on services is also not going to be coming until 2029. So businesses are going to have to spend the next 3 years trying to figure out how to deal with this new regime, adjust their systems and begin complying with it, and hopefully seeing it going away in 2029. But as Cyndy noted, all these future dates are subject to future legislators making different decisions. So we'll have to wait and see. The other big rollback, which actually did occur on a more current basis, is rolling back the estate tax increases to the pre-2025 estate tax exemption thresholds and rates. Although if you're unlucky enough to die between July 1, 2025 and June 30th of 2026, your estate will be affected by last year's increases. One of the other things I wanted to mention is the large number of taxes that didn't pass this year. And I've got these listed in an intentional way. One of the things you're going to be hearing during the policy discussion is concerns about regressivity. Everything on the left-hand side are regressive taxes that the legislature is considering adopting. The other aspect of it is most of the ones, everything below that line, are sin taxes, where the theory is if you tax this item, you're going to get less of it because the tax will change people's behavior. On the right-hand side are taxes against businesses and wealthy individuals that the legislative theory is, unlike a sin tax, nobody's going to change their behavior if we tax this more. And so with that, if there are any questions.
Each and every person in this room I know is personally affected by the policies passed at the state level in particular, because each of you enjoyed an additional sales tax bill on your ticket to attend this wonderful lunch today. And the administrative nightmare that has ensued in enabling sales tax on these lunch tickets has been a giant pain in my ass. So thank you for coming. Thank you for paying it to the state. Neil, let's start with you here. You got $9 billion in new taxes. You got $12 billion the year before in new taxes. There is a common refrain in Olympia that they are out of money every year. They walk into session with massive deficits on day one that they need to fill. Is this income tax, this is a loaded question, I'm going to ask it and I'm going to try to do a state for it. Is the income tax a long-term solution?
Well, first of all, thank you, Joe, for the invite to speak today, and great to see all of you. I see a lot of old friends here. I was distracted by the income tax that I paid last night. I did indeed file last night, and when you have to cut a check, who's in a hurry to do that? If somebody can put the slides I have up, that would be great. I brought visuals. It's easier to see this in a visual way and understand it. If you think about where the state has been and where it's going, for context, between the Great Recession and COVID, the state economy was cooking along pretty good, 15 to 20% increases in revenue every biennium. Then we got to COVID. The economy was largely fueled by federal relief money, both at the personal level, and the state got a lot of COVID relief dollars. And so revenue continued to come in. Things were going well. You get to the end of COVID, and the economy has a little bit of a hangover. You can see on the screen there, revenue in the 23-25 biennium was just 3.5%. The COVID relief money was gone, and we had a little bit of a pause in the economy. The inflation started, interest rates started, and the economy just sort of cooled off. Well, the state essentially ignored the memo because in the 23-25 biennium, they increased spending by 15.8% at a time when revenue was 3.5%. And I call this the original sin, because you can see from this chart very clearly that the revenue and spending lines inverted. We were doing very well until the 23-25 biennium, and the state kept spending through that hangover in the economy. And all the conversations we've had since then, $9 billion in new taxes, income taxes, is all an effort to try to get that revenue line back up to where the spending line is. And essentially, the legislature has not been willing or interested in making the spending line come down too significantly to match up with the revenue. They focused more on getting that revenue line back up to the top. So then we think about, okay, is the income tax enough? Is the income tax going to be the thing that saves us? This chart includes, the bottom line is the revenue that projects out into the future. It includes the $9 billion in new taxes from last year and the income tax for this year. So what you can see is clearly that spending line will need to bend in order for it to match back up with the revenue line. The income tax by itself is not going to be the thing to solve the problem. And just to give you like some numbers to go along with that, in the session that's coming up, the 2027 session, the legislature will adopt the 27-29 budget. In order for them to make that budget balance within existing revenues, they'll have to limit spending growth to 2.8%. Traditionally, the average spending increase for a biennium is about 10%, so significantly lower than what they would normally do. If they spread that out over 2 biennia, they would need to increase spending by 7% in both biennia. So again, significantly lower than what they traditionally do. The answer to the question about whether the income tax will be the thing to solve the problem is entirely dependent on whether the legislature makes the decisions to fit their spending within the revenue that they've passed.
And thus far, they've really shown a penchant to be able to do that, right?
They
No.
have not been super interested in trying to line those things up.
Well, I go back to real quick here because we see the giant increases in spending. Where is that spending when the rubber meets the road? Where are those dollars actually going out? What has been increasing in state spending? And I point that out because so many of the times that we hear that there's a new tax and it has to go, or we got to fund education. Education is underfunding. Is it going to education, or is it going to something else with these new taxes?
Yeah. So largely. During that period between the Great Recession and COVID, we spent a lot of money on K-12 education around the McCleary decision. Since that time, since around 2017, 18, the money has gone into everything that's not education related. So you think about, just personnel costs. That's a big story. Like every year they do a new collective bargaining agreement. You have to pay employees, childcare, housing. Special education, not the core K-12 education. There hasn't been one thing. It's been a lot of things not K-12 related.
And Scott, I want to ask you, as this relates to behavior that you're seeing with your own clients, there's a talking point that this isn't going to have any sort of impact on people's mobility, their residency, where they domicile their business. What are you hearing from the people that you represent?
Well, quite frankly, I think that is a wish not reflective of the reality. And to some extent, I think there may have been some historic truth to that a single one-time bump in cost is not the type of thing that is going to cause an individual or a business to get up and move. But what you saw on the slides is a large number of different significant increases, many of them enacted without any input from the affected taxpayers, and written in a way that even understanding how to comply with them is completely unclear. One of the things that's important, I think, for businesses is some level of certainty and predictability. And the point has gotten to where the business climate is just severely degraded. Businesses are, concerned about, doing business in Washington, and certainly, in addition to trying to figure out how to comply with all these new things, to the extent they're looking to expand, they tend to be looking outside the state. And historically, I would say, when I would hear people within the firm talking about people moving out, it was exclusively individuals working with our private client services group. we're now having conversations with businesses about, where to be thinking about location and what would be involved with, with either expanding outside of Washington or, moving outside of Washington entirely.
And Cyndy, you've got a lot of high net worth individuals that you represent, and individuals that own a number of businesses. And one of the big talking points that we heard going into the legislative session is that because of the big tax reductions that were in the One Big Beautiful Bill, or whatever you want to call that federal piece of tax legislation, because there was a lot of reductions in taxes in there, that opened up a lot of capacity for high net worth individuals at the state level for those tax wins to then be picked up by the state. Is that an accurate representation? And it was kind of like a 1-for-1 with the dollars that came in for the income tax, or is that a little misleading?
Short answer?
Yeah.
No. Yeah, the short answer of that is no. Because a lot of the changes in the federal tax legislation actually maintain status quo. So for a lot of individuals, it was more or less, I get to keep paying the same taxes rather than having a tax increase in 2026. So most people aren't going to feel like I all of a sudden got a tax break. The SALT is probably the biggest one, but for really wealthy people, that phases out once they're at $600,000 of income. So it's really not a big tax windfall that everyone's been talking about. And when you look at it at the state level, they don't want to all of a sudden I don't have to pay something on the federal level, so I should give it to the state. I mean, it just doesn't really work that way. It's like, okay, I'm going to save this money instead or spend it somewhere else. And so we are seeing a lot of angst over the tax law changes in Washington. Again, it gives me job security because I have a lot of people I'm talking to about, well, what can I do about these taxes? And I have been working with quite a few business owners, extremely wealthy people, about exiting Washington. And so, when you talk about the revenues that are going to come from that tax, it's like, well, who's going to be here to pay it?
Well, let me dig a little bit deeper into that. First off, on the statistics for the federal tax cuts, I went and did the math one day, and it turned out to be about $3.7 billion in new revenue for the income tax, and the reductions, at least the state version of the reductions from the federal change, was around $200 million or so like that. So the magnitude of difference is just shocking, given the talking point. But let's dive back in there a little bit more, because I think a lot of folks are really concerned that their jobs are going to be moving out of state, that even if their job isn't moving out of state, the next job isn't going to be created here in the state. How accurate are those concerns? How do we measure that? And what do the next few years look like to really determine whether or not that's something that we should be hitting the panic button about?
Well, I think it depends. For the high earners, they're the ones making the decision about where the company is going to be. And the more that you have taxes on the high earners, the more likely they are to want to leave the state. I mean, there's other obvious reasons that you stay within the state. You can't move an orchard to another state because you can't pick up the orchard and move. But for service industries, service businesses, I mean, even people I work with are talking about packing up and moving, which means that the support staff that work with them are either going to have to work out some sort of arrangement, or those jobs, like you said, are going to move to another state with the high earners. So, I mean, I'd love to hear what my fellow panelists are seeing as well with this, because I just know anecdotally from the business owners that I'm working with, they're tired of kind of getting, nickel and dimed by Washington, and it's always the concern of, well, what's the next tax that's going to hit me? And what can I do? How can I avoid this? What other states are more friendly to me and my business? And that's where we start to look at what are all the different factors. And taxfoundation.org has a really fantastic comparison tool that shows the corporate tax, the sales tax, property tax, income tax, and then I always throw in estate tax because that impacts the wealthy families that I'm working with, to say, how do we rank? And Washington is not very favorably ranked, which surprises a lot of the clients that I talk to, because they sometimes only look at it from that income tax sleeve. And now with this new truly income tax, not just a millionaire's tax, to Scott's point, it's becoming worse and worse.
Yeah, the half of all taxes in the state of Washington are paid for by businesses, and so as we think about, what are we doing to attract an economic development, it gets really difficult. I want to bring up something that you talked about a bit in your opening remarks, which goes back to one of the talking points about Washington and its tax structure, and that it is either the most or second most regressive tax structure in the state. Regressive in the sense that the lowest income Washingtonians are paying a much larger percentage of their income compared to the higher net worth Washingtonians. And that was a real moral driving factor for legislators to adopt this change, both the hike in the estate tax as well as from 2 years ago, as well as the capital gains tax, and now, of course, the high earner income tax. Is that analysis accurate, or are there other ways to look at the regressivity of our state?
Well, I think that no, it's not accurate, and yes, there are other ways to look at regressivity. There are a couple elements of that claim. Probably the biggest one is that Washington relies more heavily on sales tax than many other jurisdictions, and the fact that we don't have a personal income tax. And structurally, the way the study was put together, those things are both counted as negatives against the state. What it disregards are things like the reality that most of the things that low-income people spend most of their money on are not subject to sales tax. There's no sales tax, doesn't apply to rent, doesn't apply to grocery. There's also an issue with how the identification of income at the lowest level is reflected. It tends to ignore transfer payments, which make up a significant part of the actual income of people at that level. The study basically assumes that at the lowest level, people's expenses are more than double their total income. Well, that's not a sustainable thing year after year unless you're ignoring most of the income that is involved. And then because of the B&O tax is treated not as if it's mostly paid by business, which are the ones that it's actually imposed on, but as if that gets passed through and it's being paid entirely by individuals. So those are key factors that completely distort the results of the study.
Yet it gets taken pretty much as gospel in the media and elsewhere about
the talking points. Everybody starts with the presumption, and in fact, the income tax notice, the first sentence about intent, the two things that jumped out at me, first of all, is notwithstanding what Neil says about where the money is going, the very first thing is it's for the children. With a misleading statement that the general fund goes to spend to support K through 12 education, implying that that's where this money is going to be dedicated to without actually saying that. And then at the bottom it ends with, and ITEP says we have the second most regressive tax system. If you look back at the list, despite that, there's no effort to stop enacting more and additional regressive taxes. And there's a belief that when we enact sin taxes, that we're changing people's behavior. But we ignore all of that when we start talking about imposing tax on business and wealthy people. What's missing is a discussion of what's good tax policy, as opposed to where can we get more money from.
Yeah, and it's interesting you bring up sin taxes. Washington State has the highest gas tax, highest cigarette tax, highest marijuana tax, highest alcohol tax, and a host of other taxes that really do disproportionately fall on lower income families. Neil, Washington Roundtable recently did an affordability study where it looked at what is driving the unaffordability issues, where is that impacting our economy as a whole, how is that impacting families? Tell us a little bit about that study and what some of the conclusions were.
Yeah, I brought a few more visuals, which if we can pop those up, it'd be great. So we, at the Western Roundtable, we, like you, have been hearing from a lot of people about it feels really expensive to live here. And, you know, obviously that's a national trend. You've got inflation across the country. But when we go to New York City, it doesn't feel as expensive. And I think we've been hearing that. So we wanted to create a baseline of data and information that would tell us the facts. So you can't work on the problem until you understand the facts. So what did we learn? What we learned was Washington is the 5th most expensive state in the country, only behind California, Washington, D.C., New Jersey, and Hawaii. Flip to the next slide. And Washington is getting more expensive faster than everywhere else. So, in fact, between 2013 and today, we grew 2 times faster than California, which is the most expensive state in the country. And then flip to the next slide. In addition to that, when you look at regions of the state, it's not just a Seattle problem. Seattle is the 5th most expensive region in the country behind only California regions, but all 12 of Washington's urban regions are in the top quartile of urban regions in the country. So there's a national narrative out there that this is just a national problem, that this isn't a Washington State problem, that, you know, this is just what everybody's experiencing. This data doesn't back that up. In fact, when you look at some of our urban areas, Bremerton is the 22nd most expensive region in the country. Olympia, 26th most expensive. Even our lowest rated region, Yakima, is the 95th most expensive region in the country out of 386. So this isn't just a national problem. There is something going on here in Washington State that is driving up costs in all areas of the state.
Scott, we've got a number of other taxes that were being proposed. You put some of them up on the screen, and the chair of the Finance Committee in the House really has publicly said that she is intent on instituting what's called a gross margins tax, typical, similar to maybe what's looked at as the Texas franchise tax, things like that. Why don't you tell us a little bit about what is that tax as a possible replacement for B&O, and how would its implementation impact business taxpayers in the state?
Sure. So in a lot of ways, the Texas margins tax, which is the model for the concept of a margins tax in Washington, is kind of a halfway between the B&O tax and an income tax, in that you start with a company's gross revenue, and then you get a deduction to come up with a taxable margin. And at least the models that have been thought about before would follow Texas in that deduction would be either cost of goods sold or compensation or some fixed dollar amount, say you get $1 million, or a fixed percentage of your gross. And the structure is basically once a year the business gets to choose which of those is the largest deduction. It would replace the different tax rates for different types of activities with a single tax rate on whatever the margin that is computed. You would still be apportioning revenue between Washington and elsewhere by formula. And I think one of the big issues, I think that from my perspective, clients face is we're talking about increased levels of uncertainty. Even if it's set to have, basically raise the exact same amount of money as the current B&O tax, some businesses will pay less and others will pay more, and it's not going to be known ahead of time necessarily exactly who are the winners and who are the losers going to be. Everybody's going to have to learn a brand new system It's going to have brand new rules. There's going to be years of figuring out how those rules actually work. And I think rather than solving problems is more likely to just replace the current issues with a whole new set of unknown issues.
And there was a lot of talk in the session of adopting the income tax that there was going to be big reductions in taxes, and one of them was the increase in the exemption threshold of B&O, so that, as they said, hundreds and hundreds or thousands of businesses would no longer be paying the B&O tax in the state as a result of the millionaire's tax. Do you know how the math works out on that in terms of how much savings that actually is for some of these companies?
I have not had an opportunity yet to look at that, the impact, but I'm skeptical that the dollars are very large, and I think it's really the smallest businesses that have the potential to be benefited.
And by just maybe a little bit.
Exactly.
Yeah, so like $1 million restaurant or an average $1 million restaurant saves about $2,000.
Probably not even that, because I'm not sure that they're paying $2,000.
Yeah.
Although the restaurant's going to be collecting sales tax.
That's true, outside their
But on
sales
the
tax.
B&O tax, you're right, it's not going to be a significant savings.
We got a couple of questions in from the audience here that I want to get to. Let's see, we've got, what's that on Joe Fain's face? Can some staff get him a napkin? Okay, that's a good question. Will the income tax withstand legal challenges? What do you predict? Neil, I'm going to address that one to you for safety's sake. Talk a little bit about what the path of the income tax is at this point legally, and what options are on the table for folks that are looking at its repeal or overturn.
Yeah, so there is a group that has come together, the Citizens Legal Action Defense Fund, I believe they call it, who's hired Rob McKenna and Phil Talmadge to challenge the constitutionality of the income tax. It will first go to district court, and they tend to pick the best jurisdictions for that. So to get a positive response, and then it is going to go to the Supreme Court. That's likely not going to be this year. Just the wheels of justice turn slowly, so that's likely to be a 2027 decision, and it revolves around whether income is property under our Constitution. There was a 1933 ruling that said income is property, and therefore it's subject to our property tax rules in the Constitution, and those taxes must be uniform. So we couldn't have a progressive income tax where we're charging millionaires differently than we're charging everybody else, and that's really what the legislature wants. And so at the center of that case is whether the income tax that's passed is constitutional. This has been an issue that's been litigated a number of times, but there is speculation that this Supreme Court at this time may see it differently than past precedent.
And for either Cyndy or Scott, looking back to that comparison conversation that you brought up around the tax foundation information, how does Washington now compare? Because the tax policies here in Washington in 2026 are remarkably different than they were in 2019 and 2018. And you see a lot of activity out of a bunch of employers these days that are really looking. You've got a huge amount of exodus of income. Maybe not residents. Washington State still may be growing by residents, but it's losing overall aggregate income. States like Nevada, Arizona, others picking up. Tennessee and Nashville obviously are getting some delicious cups of coffee here in the near future. So how does Washington State compare in that space? Whoever wants to grab that one.
So from sales tax, I think we're ranked 49th. Out of 51, because Washington, D.C. is counted as a separate line item. Property tax, I believe it's around 35. And then income tax is where we actually look okay, but it's still before this new millionaire's tax and before the capital gains tax change, I think we were at about 14 for our rank. So when you look at that and we start talking to clients about where do you want to live, I've been helping clients to move to jurisdictions that you would be somewhat surprised by it because they're willing to pay an income tax to have better other taxes, if that makes sense. So we have people who are moving to Montana, which doesn't have a sales tax. We're having people who are moving to Idaho because they like Sun Valley. Or they're moving to Nevada because Nevada doesn't have an income tax. It also doesn't have that estate tax. The estate tax started the trend of people running for the hills with the 35% rate that they passed last year, that they walked back this year. But now with the capital gains tax at 9.9% for the income over the $1 million, this new millionaire's tax at 9.9%, it's just opening up that floodgate, I feel. And even the clients who have always historically said, I'll never leave Washington. My kids, my grandkids are here. They're like, I'm going to leave Washington for 183 days a year. So what are you seeing, Scott?
Well, we're seeing similar things, and my practice doesn't deal on as much with the individuals as yours does. But when I talk to my colleagues in that same space, that's all. Seems like the only thing they're doing these days is helping people move out of the state.
So we know that that the tax conversation is really, at the end of the day, a spending conversation, because the decision to spend is the decision to tax. You're either going to tax today to pay for that spending, or you're going to tax tomorrow to pay for today's spending. So given that, Neil, what are the best reforms that the legislature and the governor could get behind that could bring those spending, the slope of that spending curve, in line with our revenues?
Yeah, we talk about sustainable budgeting all the time. And the idea of that is don't spend so much today that you create a problem for yourself tomorrow. And so we have a 4-year balanced budget requirement in the state. The legislature passes a 2-year budget that then has to project out 2 years and balance for the next 2 years. And the idea of that is that you're planning for the future, that you're passing a budget that you can balance the next year. Through this period of time, we've found some cracks in that system. And the cracks are, I would point to 3 things. One is when the legislature spends one-time money on ongoing programs, that's where they get themselves into trouble. 23-25, they spent $4.8 billion more than they took in. That created a spending level that they couldn't sustain going forward. Even though the budget looked balanced over 4 years, when you start projecting forward that one-time spending, you get yourself into trouble. So the first reform would be don't spend more than you take in. The second thing is don't project revenue that the economists tell you you're not going to have. So one of the cracks in the 4-year balanced budget requirement is the legislature is allowed to use 4.5% per year revenue growth as their assumption of revenue, when revenue from the independent economic forecasters that they hired don't say that it's going to be that high. And so they are allowed to assume phantom money that the state's economist doesn't think is going to come in. We think that's a bad idea. We think they should never do that, and they should just get rid of that ability altogether. The third thing is they should do a better job of planning their expenses in the future. They are required in that 4-year balanced budget to carry forward their expenses into the next biennium, but there's always caseload expenses, like the number of students in K-12, the number of people in Medicaid. Those are automatic expenditures. We always have those kind of expenditures that come up every biennium, but it's not required to be part of the 4-year balanced budget requirement. Similarly, collective bargaining agreements are not required to be accounted for in the 4-year balanced budget requirement, and yet we know they negotiate them every 2 years. So do a better job of planning for the expenses that you know are coming and leaving yourself room to be able to sustain those expenses within existing revenues.
Those all sound wildly controversial. Don't spend money you don't have. There's an SNL skit that I recall that had that theme, and it's a very good one. Maybe we should send that to our legislature. Why do you believe that those reforms haven't been widely accepted and adopted?
Well, for a number of reasons, probably no surprise to all of you, legislators tend to have a pretty short time horizon. They get elected every 2 years or every 4 years, depending on what position they're in. So, we have to pass a two-year budget today, that accomplishes everything that we need to and takes care of our constituents. And, sometimes the attitude is, we'll cross that bridge when we come to it, in a couple of years from now. So that's one thing that's driving it. The second thing that's driving it is sometimes hope is a strategy. So, you can say, well, we'll spend this money today, and then the economy could get better. The federal government might help us out with some of those healthcare expenses. Hope is a strategy sometimes is something the legislature employs.
This has been a deeply uplifting conversation. I'm really glad to have been a part of it here today. Quick show of hands in the audience here today. How many folks, either yourself, a friend, a business colleague, know of someone who is either thinking about or in the process of leaving the state of Washington, or at the very least has made the decision not to hire anymore here in the state of Washington? Let's see a raise of hands. Let's try this again. Raise your hand if you don't know anybody that is even thinking about relocating. Okay, there it is. That is a very sobering statistic. Folks, please give a round of applause. You can stay up here as we close out, but please give a round of applause to Neil, Scott, and Cyndy. Really appreciate all of you being here today. We've got another set of fantastic programs coming up in the months ahead. In fact, next month we are right back in here, but we're traveling across the bridge. We are bringing over West Side Story, the East Side conversation about the future of Seattle. Obviously, a lot of the themes that have been brought up here today about onerous taxes on business and the economic environment, a lot of that is going out in real time in the city of Seattle, and so we have a great panel. Tiffany Connell, accomplished realtor or real estate broker, commercial and retail on both sides of the lake. John Scholes, the president and CEO of the Downtown Seattle Association, and Joe Nguyen, my colleague, we call him Westside Joe, the CEO of the Seattle Chamber of Commerce, and the four of us will be up on stage talking about what's going on in Seattle and what are some of the lessons to learn and what's the future there. Also want to encourage folks to sign for our May 5th, 2026 legislative wrap-up, where we are bringing our legislators to talk about what happened at the legislative session. I didn't think we were going to get anybody that was going to be brave enough to show, but I offered Nikki a set of steak knives if she could get to at least 5 legislators, and I think she's almost there. Our Believe nonprofit event at the Bellevue Botanical Gardens is on May 28th. And of course, our Bellevue Regional Awards Gala, or BRAG, is our big signature event of the summer on June 5th at the Hyatt Regency. Please go to bellevuechamber.org to register for these events, but also our BRAG event just yesterday opened up nominations for a host of the awards that we will be giving out that day to celebrate the best nonprofits and elected officials and small businesses and signature experiences here on the East Side. And so your nominations are welcome right now, and then we will do a round of voting just in advance of the event itself so that we can hand those out. I want to thank our great sponsors, Columbia Bank, Vulcan Real Estate, the Bellevue Collection, our networking leader, Clark Nuber, our media partners at Lotus. And of course, I want to thank all of you for being here today. I want to thank all of you for paying your taxes yesterday. Thank you so much. Another round of applause to our great panel. Have a great day.